Good morning, ladies and gentlemen. Um, Today we'll be looking at the grade 10's work as far as our ATP is concerned for the third term. We are supposed to be doing adjustments that will be a build up to final accounts, and then from final accounts we'll be doing the financial statements. But for this, for today, we'll be only looking at the final, the adjustments, as well as the trading account and the profit and loss account. Now, without any waste of time, I would like us to look at our question. Remember, when we are supposed to do the adjustments, firstly, we must identify financial period. Financial period. When is the beginning of the financial year, and then when is the end of the financial year? Secondly, be able to analyze. We must analyze the adjustments. You analyze the adjustment to arrive to be able to determine whether it is the adjustment is prepaid, expense, accrued expense, accrued income, or income received in advance. Now, how do we know if an adjustment or an expense is prepaid or accrued? At the end of the financial period, if an expense, say for instance insurance or water and electricity, is prepaid for the next financial year, or that particular expense overlaps to the next financial period, then you know it is prepaid expense. Now, how do we know if it's accrued expense? At the end of the financial period, if we still have to pay a particular expense, then it is accrued. Now, what are the signs? Because we are going to need the signs when we prepare our profit and loss account. Prepaid, you subtract; accrued expense, you add. Now, if you come across any adjustment where any income adjustment where at the end of the financial year, we still that particular income is still receivable. The business is still have to receive that income. Then it is accrued income. We add. Right. Now, if at the end of the financial year, and then we have received an income for the next financial period, be it from our tenant, then it is income received in advance. We subtract. Remember from the first term work, when in terms of our accounting equation, any asset account, we said it increases on the debit side, decreases on the credit side. Now, prepaid expense, accrued income, both. Remember, in our balance sheet, we record them under trade and other receivables under current assets. So now they are type of an asset account. They increase on the debit side, decreases on the on the credit side. Now, any liability account, any liability account, in this case, it will be income received in advance or accrued expense. Name. Other liability type of accounts, name. They increase on the credit side, decreases on the debit side. Now, lastly, we have owner's equity. Owner's equity account. Within owner's equity account, we have expenses that decreases our owner's equity. And then we have incomes that increases our owner's equity. You'll see from the question 1 there, when we are about to do at the profit and loss account. I will show you when we get there. Now, let's quickly look at our question 1. Let's quickly look at our question 1. It says here, pre-adjustment trial balance of Makume Traders on 30 June 2020. The end of the accounting period is given. Show the journal entries of adjustment 1, 2, 4, and 5. Now let's go check there. Let us go check there. 1, 2, 4, and 5. Now, the first one, it says here, a part of the building has been let for the past 2 years at 1,700 per month. Rent for July 2020 was received. Rent for July 2020 was received. Remember, I said to you, be able to identify when is the beginning of the financial period and when is the end of financial year. In this case, the end of the financial year is 30 June 2020. Then it means the beginning of the financial year would be a day after this one, which is 1 July 2019. Now, our adjustment number 1. Adjustment number 1 says here the rent was received for July 2020. July 2020, it's the first month of our new financial year. Now, any income that we have received for the next financial year, I said it is income received in advance. Remember, income received in advance, I said it's a liability type of account, and liability increases on the debit side. That is why here we credit income received in advance. And then we debit the rent income with 1,700 and 1,700. Be able to identify the account out of each and every transaction. Let's go to our adjustment number 2. It says then interest on fixed deposit not capitalized at 7% per annum is still receivable for 4 months. Then, interest on fixed deposit, this is an income, right? And they are saying here it is still receivable for 4 months, meaning that 4 months we still have to receive it. Therefore, it is accrued income. Remember, I said accrued income is it's an asset type of account. Remember, I said any asset account increases on the debit side, decreases on the credit side. Therefore, here we'll write accrued income. right? And then on the credit side, we'll write the interest on fixed deposit, right? Now we must calculate. We must calculate. Let's look at our trial balance. Remember, the interest rate is at 7%. Our trial balance is there. Look at the fixed deposit. Our fixed deposit at Tima Bank is 12,000. And then we'll just multiply by 7 divided by 100. And then times 4 divided by 12. Right. Our fixed deposit that we have invested is 12,000. Just times by 7 divided by 100 times 4 divided by 12. It will give you 280. Right. Let's record it here. 280. 280. Right. Then let's go to adjustment number 4. Adjustment number 4. It says there, insurance includes an annual premium of 1,440 that was paid on 1 November 2019. And annual means that 1,440 is paid for the whole year. But now look at the date on which it was paid. Now, it was paid on 1 November 2019. Right. Now it was paid for the whole year. It was paid for the whole year, meaning from 1 November up until, it means now if it is for the whole year, it means we'll start now to count 12 months from 1 November up until, it means it was paid from 1 November up until the end of October, 30th October, right? 2020. Right. Now, this is an expense account. An expense account, and as you can see, it overlaps to the next financial period, because here is it's the end of our financial year. Now we are only interested on the amount that that particular expense is prepaid. That the amount that overlaps in the next financial period. Now let us check from November to 30 June. It's November, December, January, February, March, April, May, June. How many months? 2, 4, 6, 8. 8 months falls within our financial year, and then 4 months falls in the next financial. That is what we are. That is what we want. The 4 months that that particular expense was prepaid for. Now, in our calculation, we supposed now to say 1,440. 1,440 times by 4 divided by 12. Let me check. 1,440 times 4 divided by 12. It's 480, right? Or alternatively, you can just divide this by 12. Let's check. 1,440 divided by 12. It gives 120, and then you just multiply by 4. It will give you 480. Now let us. So the insurance was prepaid for 480. Now let us record. Remember, prepaid expense, accrued income, asset type of account name. So now an asset increases on the debit side, decreases on the credit side. Here at number 4, we'll just debit here prepaid expense. Now, and then we credit insurance. Now, and then with 480 and then 480. Right. Let's go look at the last adjustment, number 5. Number 5 says an amount of 525 is still owing for repairs. People, repairs is an expense account. Any expense account that we still have to pay, that we are owing, it is accrued expense. Right. Accrued expense falls, it's a liability type of account, right? Like any liability account increases on the credit side, decreases on the debit side. Now here we'll debit repairs, and then we'll credit accrued expense. Now, with 525, 525. Right. Just for us to go back, any asset account would increase on the debit side, decreases on the credit side. Any liability account increases on the credit side, decreases on the debit side. Owner's equity, we have expenses and incomes. Expenses decreases our owner's equity, hence always debited, and incomes increases our owner's equity, hence always credited. Now let's look at the final account. Now the final account, which is the trading account. Trading account, on the debit side, for this final account, trading account and trading account and profit and loss account. Now, we make use of nominal section accounts. Nominal section accounts, remember I said, on the debit side you'll get your expenses, and then on the credit side you'll get your incomes. Right. Now on the debit side of your trading account, that's where now you will record your cost of sales, and then on the credit side you'll record sales. Now let's look at and then we close it off with profit and loss account, and then that amount will transfer it to our profit and loss account. Now let's look at our nominal account section. Now we have cost of sales here to the value of 626,000. And then we have our sales, which is 880,960, and then we subtract debtors. Please remember to subtract debtors allowances. What are debtors allowances? Debtors allowances are the returns from our debtors. So now hence we decrease our sales account. Hence we subtract debtors allowances from our sales account. Though that 4,560 is are returns from our debtors. Now the sales amount, it will be net sales, it will be 880,960 minus 4,560, you get 876,400 rand. Now we must balance this T account again, the bigger amount, which is 876,400 on the credit side. We'll write on both sides, and then we'll balance it with profit and loss account. profit and loss account. Our profit and loss account would be 626,000. It will be 250,000 for 400 rand. This profit and loss account of 250,400 rand. When we cross over, to our profit and loss account, remember it's on the debit side of our trading account. Therefore, we'll put it here on the credit side here. We'll write here trading account. And then it will be 250,400 rand. Right. Right. Now, here we come to our profit and loss account. Under profit and loss account, I repeat again, let's go check our trial balance. Remember I said to you, for us to do profit and loss account, we need to do, we prepare our profit and loss account with nominal section accounts. Nominal section accounts will be, within our nominal section accounts, we'll get the expenses that are on the debit side, and then incomes that are on the credit side. We prepare profit and loss account with nominal section accounts. Now, for starters, let's look at our nominal section accounts. Let's look at our nominal section accounts. Sales we have already dealt with. Sales, cost of sales, debtors allowances, and then rates. Rates, you go check your adjustment. Do we have anything for rates here? Any adjustment for rates? Not. No, we don't have. So we take it as it is. We take it as it is. So on the debit side of our profit and loss account, that's where you'll record your expenses. So here it will be rates, and then it will be how much? 2,000. Our rates, 2,630. 2,630. Right. Then we go back to our nominal section accounts, wages and salaries. You go check on your adjustment if we have any adjustment regarding wages and salaries. We don't have. So we take it as it is, right? Here we'll have salaries and wages. How much is it? It's salaries and wages 164,545. Right. Then we go to the next one, stationery. Then we go to stationery, and then we check if we have anything, any adjustment for our stationery. Look at number 8. It says that the following was on hand according to physical stock taking on 30 June 2020. At the end of the financial year, stationery on hand was 218, right? And then look at how much did we have for stationery, 1,980. So we'll subtract what is on hand, which is 218, and then the balance would be the balance would be an expense. It will be the stationery that we have used. Then 1,762. Right. Let's go back to our trial balance, and then we have packing material. Let's go to our the very same number 8. No. Before we do the packing material, just here, the following was on hand according to physical stock taking done on 30 June 2018. No. Trading stock. Trading stock, when we count, we have a trading stock of 36,990 on the ground, right? But look at our books. According to our books, according to our trial balance, the trading stock is supposed to be to the value of 38,440. So basically, what we are counting is lesser than what appears on our books. So therefore, in that case, it will be trading stock deficit. It is a loss. No, it is an expense, right? In expense, you debit on the profit and loss account. Here we'll write trading stock, open bracket, how much there? 36,990 is what we are counting. Trading stock 38,440. And then we subtract 36,990. And then you'll get 38,440 minus 36,990. You'll get trading stock deficit to the value of 1,450. Let's go back to our trial balance. Packing material 5,250. Now let's check if we have any adjustment of the trading packing material here. Nope, we don't. Right, so if we don't, we take it as it is, right? So here you'll write packing material. Packing material 5,250. Right. Then we go back to our trial balance. It's bad debts. Bad debts, it is another expense account. Let's check if we have any adjustment regarding that. Look at number 3. Debtor Pitzeger's account of 200 must be written off as irrecoverable. Ladies and gentlemen, for when we write off a debtor, our bad debt account will increase. So now this 200 rand will be added to the amount of bad debts that we have on the trial balance of 920. So it will be 920 plus 200. That will give us 1,120. Right. Then let's go to another one. rent income. Look at 22,000. It's on the credit side. Remember I said to you, on the debit side of our profit and loss account, we record our expenses, and then on the credit side, we record our incomes. Now, therefore, here we'll record rent income. And then the rent income that appears is 22,000. The balance is 22,100. Remember, from our adjustments, we had income received in advance of 1,700 rand. And then I said to you that income received in advance we're supposed to subtract, right? Now we go back to our rent income. We subtract 1,700. 22,100 minus 1,700, you get 20,400 rand. Right. Let's go back to our question. Interest on fixed deposit. Interest on fixed deposit, that is an income. We credit interest on fixed deposit, right? Let's check the amount on the trial balance is 560. Remember your interest on fixed deposit. Let's go to our general journal. We had interest on fixed deposit that we still have to receive to the value of 280. Right. And then it is accrued income. Any accrued income, we add. Right. So we go back to our interest on fixed deposit, and then we add here 280. Right. So it will be 560 plus 280. It gives you 840. Right. Let's go back to our trial balance. Insurance. Insurance is an expense. Account. The balance there, it is 3,660. Remember, we had a prepaid insurance to the value of prepaid insurance to the value of 480. Any prepaid expense, we subtract. Right. Let's go back there. We have prepaid of 480. So here it means we must now subtract 480 from 3,660. So we'll subtract 480 there. $3,180. Right. Then we go back to our trial balance. It's telephone expense account, right? Open bracket. Telephone 5,790. And do we have any adjustment regarding it? Do you have any adjustment? Let's quickly check. No, we don't have. So we take it as it is. The balance there would be 5,790. Right. 5,790. Then we go back. Let's go back to our adjustments. To our trial balance. We are here. Interest on mortgage loan. This is an expense account. Interest expense. Ne? We check now whether we have any adjustment for it. Interest on loan, right? It's 3,300 rand, right? 3,300 rand. But now let's check. Let's go back to our adjustment. Adjustment number 7. It says here, interest on loan for the year is 3,600 as indicated on the statement received. You see, the statement came and then our interest is 3,600. But our trial balance is only showing how much? It's only showing 3,003. It means now we still have to pay the difference between the 3,300 and 3,600. This is accrued expense. Hence we added the 300 rand. Right. Let's go back to our trial balance. Water and electricity. Let's check if we have any adjustment for it. Water and electricity. No, we don't. So now we take it as it is. Now, water and electricity, it is an expense account. Therefore, it has to be debited, and then it is how much? 5,825, right? And then discount allowed. Remember, ladies and gentlemen, discount allowed decreases our owner's equity. Anything that decreases our owner's equity, it is an expense account. On an expense account, I said to you, on the nominal account section, you'll get them under debit column. So now here we'll write discount allowed to the value of 2,500 rand. And then lastly we have discount received. Look at that 1,525. It's on the credit column. It means it is an income. Any income account we credit. Now here we'll have discount received to the value of how much? 1,525. 1,525, right? 1,525. Now, we have reached the end of our the nominal section accounts that are listed here on our trial balance. But then what is it that as far as our adjustment we did not calculate here in our profit and loss account? We did 1, we did 2, we did 3, we did 4, we did 5, but 6 we did not do. Depreciation. Depreciation is calculated on our fixed assets at the end of the financial year. Now this is how you should. This is how we should record it. On our profit and loss account, we'll write the depreciation, and then inside brackets, we must now calculate 15% of on cost price for vehicles and 10% on diminishing balance method. Now, those are two types of depreciation method that we are having. 15% we calculate on cost. let's go to vehicles. Ne? Vehicles 60,000. Ne? So we'll be saying 60,000 times by 15%. Ne? It will give us 9,000, right? This is for vehicles. Ne? Go back to our trial balance. Right. They say here, equipment at 10% per annum on diminishing balance method. Diminishing balance method means 10% of the depreciation will be calculated on the carrying value. Carrying value means we'll take the cost price for equipment, which is 26,400 cost, minus accumulated depreciation on equipment of 4,720, and then we'll get the carrying value. And then we'll get the carrying value of how much? Let's check. 26,400 minus 4,720 is we have the carrying value of 21,680. But what is the rate? What is the rate is 10%. So now it will be 21,680 times 10 divided by 100. It will give you 2,168. Yes, 2,168. 21,680 times 10, it gives us 2,168. But on the very same, during the year, there's a note here that says equipment with a cost price of 12% was purchased on 1 November 2019 and recorded correctly. Right. Now you check. Now you check. We bought equipment to the value of 12,000. New equipment. This is old, right? And then we have new. So this new that we bought it when and for how much? For 12,000. And then on 1 November. So now it will be 12,000 times 10 divided by 100. But we had this equipment from 1 November. From 1 November. Here is our timeline. From 1 November up until 30 June 2020. Right. So we had it for 8 months. I get it. From November to 30 June here, you can count. It's November, December, January, February, March, April, May, June. June is our financial year end. So 2, 4, 6, 8. So now we had this equipment for 8 months. So it will be times 8 divided by 12. Let me just write this 2,168 of old. Then we add the new one. 12,000 times 10 times 8 divided by 12. It gives you 800. So now we have 800. So here it's depreciation for equipment of 9,000, and then 2,168 for our for old equipment, and then 800 for new. So all in all, it will be 9,000, 2,168, and then 800. So we have 11,968. We have 11,968. 68. Right. So now I think let's go to our trial balance. Everything is captured. Everything is captured. So now once we have arrived at the end of our adjustments, and we took the amounts from the trial balance that was not addressed by our adjustment. Now we can close off our profit and loss account. And remember, we close off our profit and loss account with a capital or net profit. So now starting from, let us check from the credit side. Credit side, we have 250,400 plus 20,000 plus 20,400 plus 840 plus 1,525. So our total on the debit side is 273,165. Now let's check the debit side. 2,630 plus 164,545 plus 1,762 plus 1,450 plus 5,250 plus 1,120 plus 3,180 plus 5,790 plus 3,600 plus 5,825 plus 2,500 plus 11,968. You arrive at 209,620. So the bigger side is the credit side. So now you write the bigger amount on both sides. So it will be here 273,165, 273,165, and then the difference between these totals here we'll record on the debit side, and then we'll write the capital or net profit. Right. Our net profit in this case will be minus 273,165. It will be 63,545. It will be 63,545. Right. Now that brings us to the end of our question 1. We did general journal, and then we did the two final accounts, being a trading account as well as profit and loss account. Now, with the 5 minutes that is remaining, I think we can also do a few questions from question 2. I have question 2 here. The question 2, let's quickly look at the question 2. It is the general journal, combination of general journal. But now, combination of general journal and the general ledger. The general ledger being debtors control and creditors control. Right. Without any waste of time, ladies and gentlemen, let's quickly look at the general journal. Our general journal is, remember I said you must always identify the accounts when you analyze the transaction or adjustment, please be able to identify the accounts that are affected there, right? So let's check this one here. 2.1, it says that generalize the adjustments on 28 February 2019. General narrations are not needed in the general journal. And then we are given provisional totals, meaning provisional totals, we still have to adjust them using our adjustments. Now, number one, it is prepaid. Insurance is prepaid for 200 rand. If insurance is prepaid for 200 rand, it means now the two accounts that are affected there will be prepaid expense and insurance. We debit prepaid expense because prepaid expense is an asset type of account. It increases on the debit side, decreases on the credit side. Then let's go to number 2. Water and electricity have not yet been paid for 1,500 rand. So this is an expense account. An expense account that we still have to pay. It is accrued expense. Accrued expense is a liability type of account. It increases on the credit side, decreases on the debit side. Now, our recording will be water and electricity. Water and electricity here. You debit your water and electricity, and then you credit your accrued expense, right? With 1,500 rand. 1,500 rand, right? Expenses are always, as you can see, we have debited our water and electricity because it's the second account and it is the expense, right? Now let's go look at number 3. Sikobe owed 160. The account must be written off as irrecoverable. Remember, when we write off a debtor, when we write off a debtor, our bad debt account is supposed to increase. And then and our debtors control account, which is our main account, is supposed to decrease. A debtor is an asset account. A debtor is an asset account. Increases on the debit side, decreases on the credit side. Now, our recording will be the firstly the bad debt. Bad debt is an expense account. Increases on the always debited because they decrease our owner's equity. And then the account to be credited here will be debtors control. Debtors control, or you can write just write debtors, and then in brackets there you can just write Sikobe. And then with how much? With 160. 160. Now what happens to what effect will that have on the debtors control account? Remember, this is an asset account. It increases on the debit side, decreases on the credit side. Now that we are writing off this particular debtor, our debtors control will be credited with 160, right? Then let's go to number 4. A dishonored payment of 140 was received from S. Peters. This amount has been recorded. Here we have a payment that was previously dishonored by our debtor. Now, it has been recorded, but it further goes on to say discount of 30 rand must still be cancelled. Now, how do we cancel what effect will that have on our general journal as well as our debtors control? Now, remember, initially, when we give a debtor discount, we credited, we debited discount allowed, right? And then we credited debtors a debtors control. Now that we must now cancel this discount allowed, we reverse. What we have debited, we must credit. What we have credited, we must debit. Now, so now here we'll write here on this how we will record it. Now, debtors. What his name is S Peters inside brackets, and then we credit discount allowed, right? 30 rands and then 30 rands. What effect will that have on our debtors control? Remember, initially we decreased our debtors control. Now that we are canceling the discount, we're supposed to add back the 30 rand. Right. Now, the last one, number 5, rent income amounts to 39,000. 1 month's rent was received in advance. Then, the rent income amounts to 39,000, ladies and gentlemen, and that is for the whole year. But they said to us that 1 month's rent was received in advance, meaning out of this 39,000, there's 13 monthly rents inside it, because they said here that 1 month's rent was received in advance. So ours is just to check how much is one rent, the rent for 1 month that was received in advance. So we'll say 39,000 divided by 13, you get your 3,000. This 3,000 is income received in advance. Remember, income received in advance is a liability type of account, and any liability account decreases on the debit side and then increases on the credit side. Right. Now, we must now record that. We'll debit here rent income and then credit income received in advance, right? And then it will be 3,000 on the debit side here, 3,000 on the credit side. Now, let's look at the effect that 3,000 has, or that income received in advance has, on the creditor's control account. In this case, it will not have any effect on the creditor's control account because we have received an income. Now, we have received an income from our tenant. The business did not do any credit from the supplier or from the creditor, so that it will not have any effect on the creditor's control account of ours. And then the totals here would be 380 here and 270 plus 160. It will be 430 there, right? Now, thank you very much, ladies and gentlemen. We have reached the end of our session. We'll meet on Monday. I think it will be the 16th. where we'll be doing the income statement. Remember, I said to you, we start with the adjustment that build up to the final accounts. From the final accounts, we must now be able to do the income statement. So let us meet on the 16th for income statement. I hope you have enjoyed the session, and you know, there will be positive results at the end of the year. Thank you very much.